Good afternoon. Coming to you from sunny but windy Park City, Utah. Market moves today, a lot of things happening. I think it's time for another touch with you on a video here, attempting to give you our background. As you know, we have been bullish on the United States economy, bullish on corporate earnings for the second half of this year. The good news is we still think we're going to have a little uptick in economic growth. We're moderating that somewhat, and I'll go into the reasons for that, but we still don't think the U.S. is sailing into a dark hole economically. There are problems out there, and there's a lot of noise for investors to digest and try to listen through. One, of course, is Greece. That's behind us, but Greece will return. All they've done is kick the can down the road, and they've lent more money to a bankrupt state. So the collection is going to have to be increased in the future. China had an 8.5% stock market decline today, and this comes after the government's attempts to buoy that market last week after a serious decline prior. So now that China's slipped off the edge again, what does it mean? What does it mean about the Chinese economy? And if the Chinese economy is really in trouble, and we suggest that it might be, what does it mean for Europe? After all, China is Europe's biggest customer. So if the orders from China cut back, you can expect Europe to begin scaling back in terms of their earnings projections and their growth projections. And it's a contagion that could go around the world. You add to this equation Janet Yellen, the head of our Federal Reserve System, and you add her desire to raise interest rates in September, and you look at what that portends. One thing, it will increase the interest burden to the U.S. government, and it'll increase our annual budget deficit. A 1% change there means another $180 billion. Translated, that's $900 per taxpayer in this country just to absorb a 1% interest rate. If it's 2 or 3 and interest rates do move back up sharply on their own, then you've got bigger and bigger deficit problems. But you've also got problems for corporations that have used this easy money period, this low interest rate period, to borrow. A quick look at GE says, you know, if GE interest costs go up by 1.5%, it equates to something like 25% of their profits will be eliminated. And of course, that doesn't bode well when you start to factor in all the other companies that have borrowed. In total, there's about $2.5 trillion that is coming due in the next 5 years in the corporate sector, in the S&P 500 alone. So this is beginning to be a cloud that's showing up. So globally, we're looking at all of these problems. The dollar strength is creating another problem because multinational companies, the Procter & Gamble's, the IBM's, Coca-Cola's, Caterpillar's, Boeing's, you know, multinational companies have to translate foreign earnings back into dollars, and that translation means lower earnings reported in dollars. And so now you're beginning to have earnings reports that are disappointing because of the dollar strength. You take all of these things into consideration, and the state of the global economy, concern about China. We don't really know the answer to China, and I think it's time to really take a hard look and cut back equity exposure, because the big thing that we're trying to get our arms around, I think, is a mood in the country, the soul of our country. The news no longer is reported that there's been a shooting by a man. That man is now either black or white or an immigrant. And you find the country in a very divisive mood. Liberals versus conservatives, have-nots versus haves, red states versus blue states. And when we look forward, because investing just includes a lot of discounting into the future, as you begin to look forward, how much confidence do we have in this country's ability to grow, in this country's ability to be stable in terms of policy? Not much, and it's getting harder to see. So our message is risk is up, and we can't ignore it, and as a result, we've taken down exposure. Patience is still required. We've got confidence in those good companies with U.S. earnings, with a very little debt on the balance sheet. But our concerns about preservation of capital, sailing into these rough winds here, has caused us to cut back exposure in your portfolios. Thanks a lot. We'll be in touch.